Welcome to Employee Benefit Plans and Business Sense.
Hey everyone, welcome into an all-new episode of Employee Benefit Plans and Business Sense with Lank and Kathleen Bass over at KLB Benefits Law Group. I am your host, Mike Leon. Don and Kathleen, they've been helping employers and benefits plan service providers navigate the complex legal requirements of employee benefit plans. They've got decades of combined experience in employee benefits law. They've been guiding clients through compliance matters, corrections, and IRS and Department of Labor audits. Today's episode, we're going to be talking about what a ROBS plan is and how this type of arrangement can affect the business owner. I have no idea what a ROBS plan is. That's why we bring on the experts here. Don, let me start with you on this. What is a ROBS plan? Let's start with that. And what's the purpose of a
great
ROBS?
question. Well, ROBS is an acronym that is rollover business startup. That's the jargon in the industry for a specific kind of defined contribution benefit plan or retirement plan that's sponsored by a company for its employees. And a ROBS plan is special because it owns stock in the plan sponsor. So it's a regular retirement plan that owns shares of stock in the plan as plan assets in the company that sponsors the plan. And it's used to finance business startups or business acquisitions. So I can give you an example of the way it works. I mean, the mechanics of that, if you're with me so far. I don't want to barrel ahead. The basic process of a ROBS is that a person says to themselves, I want to start a business and I'm going to use a ROBS plan. And they have to start with some qualified funds in a different account, such as a traditional IRA or an old account at a former employer. That's their account. So their IRA or their participant account in an employer plan that they have accumulated over the years in the past may have accumulated in these accounts a good chunk of money. Say they've accumulated $500,000 in savings in these in one or the other of these vehicles. They then take that cash from that IRA, for example, and roll it into a new plan account that's been established by a new C corporation. So new C corporation is formed, adopts a qualified retirement plan that's just a regular profit sharing plan or 401k plan, and sets up a plan account for the entrepreneur. Entrepreneur rolls funds into the plan account and then directs the plan to invest his plan account or her plan account into stock of the C corporation. So in that way, the founder of the company has funded the company with his or her retirement savings that are still tax deferred. And the reason people do this is, well, there's two reasons. One is they often have no other source of funding for themselves, and they need to find, maybe they're getting an SBA loan or something, but they often don't have, that's like their biggest personal asset is this balance in their IRA or this balance in a former employer's plan. And they need the money. And then the other reason to do it is that they can do this, use a ROBS to avoid taxation for using that money right now. The ROBS structure permits them to keep that plan investment, that investment in the new corporation, to keep it tax deferred so that there's no tax hit to the individual participant for using those funds for his or her new business. It's very powerful.
And I would just add that it's basically just like, as Dahl had said, the entrepreneur is as a participant in this new plan is directing the investment in the stock, and it's just like any other investment. They can direct it into mutual funds, or they can direct it into bonds, and one option under the plan would be the stock of the employer. So
right. And so there's a few logistical issues that have to be resolved initially, which is the plan document needs to permit this type of investment. The corporation needs to authorize issuance of the shares to the plan. The company must be a C corporation. It cannot take the S election, and it can't be any other type of entity. It must be a C corporation. And of course, the it must be an operating company, an actively operating company. And it cannot, and the entrepreneur must be an eligible employee in the plan, eligible to participate in the plan, which means that he or she must actually be working as a W-2 employee for the company. They can't just be a director on the board. They need to be actually providing personal services to the company.
Yeah. Doc, let me ask you, can you kind of differentiate? I know you did a little bit of it, but can you differentiate a little bit more about how it's different than a 401k? Because my understanding of 401ks is like, if I do leave a company, I can roll it over somewhere else, or I could take out a loan, which would be taxed, obviously. If I have any outstanding loans, I know how this works. So, but I would love for you to explain a little bit more the difference.
Oh, those are really great questions. The difference, it actually, a ROBS plan is a straight up ordinary 401k plan or profit sharing plan. So 401k means that there's deferrals permitted under the plan. So that's when we say 401k, we mean that you can defer your salary into your plan account. A profit sharing plan is a company will contribute to your retirement savings for you. So when we say profit sharing and 401k, ROBS plan could be either. So I'll just stick with the term 401k for clarity, for ease of example. So the difference between a ROBS 401k plan and a regular 401k plan is really nothing except the ROBS investment itself. So every other aspect of the 401k plan still applies to the ROBS 401k. But in addition to those ordinary rules that apply, there's also this special asset, this one special asset in the plan, which is the stock held inside that founder's plan account. So that plan can provide for participant loans, which is what you referred to a minute ago, that the participants may borrow cash from their plan accounts under a separate program, which the plan document may permit, which allows them to borrow money from themselves from their plan account. That's fine, but that's not the same thing as the ROBS. All of the other, all the sort of the 401k rules that you're aware of do apply to a ROBS. But then in addition, there's a special employer stock held in the founder's account. And so what makes it tricky, I think, one of the things that people have to keep in mind is that when you do with the ROBS structure, when you use this structure to finance your company, you're stuck with certain rules that apply to that asset that will not apply to other 401k plans, because those other 401k plans don't have this asset. So because the stock is held inside your plan account, there are a lot more compliance concerns and rules to follow that the ROBS owner, that's the name of the entrepreneur who's done this, the ROBS owner needs to be very much aware of these compliance issues to steer clear of the pitfalls. They're very expensive compliance hassles that can arise if someone's unaware of the rules.
Well, let's talk about that. So what if a ROBS owner right now, because you just mentioned how the arrangement could affect, the business operation, but what if a ROBS owner wants to get out of the ROBS arrangement? What are the ways to exit?
Yeah, that's a really good question too. When you go into it, you're tying up the cash in your plan account in your company. Your company's using that cash as to buy operating assets and to make money and generate revenues and all of that. But it's in your company. It's like it's circulating. The cash is now circulating and growing inside the company. The company is hopefully increasing in value, using your funds and generating more funds. Company has its own bank account. It's paying its employees. It has relationships with vendors and customers and all of that good stuff that companies do. But if you want to get out of your ROBS arrangement, you need to, there are different ways of doing it, but you need to to get out or to exit the ROBS arrangement means to get the stock out of the plan account. Well, there's two general ways of doing that. One is to distribute the stock under the terms of the plan document, which is a pretty routine concept in retirement plans, that the retirement plans have distributable events. And if the factual conditions meet the conditions for a distributable event, then the stock can be distributed out of the plan to the participant. So that's one way of getting the stock out. Usually that's limited to such things as retirement from the company. So the distributable events are usually towards the end of the person's working life. They have to turn, if they turn 59 and a half, they can get a distribution from their plan account, separate from employment from the company, which is the same thing as retiring, basically. Those are conditions that would allow them to get the stock distributed to themselves from their plan account. And that's an exit from the ROBS, because now the asset is no longer in the plan. The asset, which is the employer's stock, is now retitled in the name of the plan participant as an individual. So distribution is one way of de-ROBSifying, if you will. And the other way is to have the company redeem the stock, which is a reversal of the initial ROBS transaction. So the company can buy the stock back. The plan bought the stock to begin with, and now the company can buy it back. But that can be very, very expensive, because the plan often owns a huge stake in the company, and liquidating all of the stock could mean liquidating the company or finding a whole new investor to come in to fund that liquidation.
Yeah, and I was just going to add, as far as the distributable events that Dahl was mentioning, a lot of plans will permit a distribution at any time for amounts that were rolled into the plan. And so rollovers, that's available. And so because this money was rolled into the plan to begin with, a lot of times it's, they can take a distribution at any time from it. Of course, there are certain, depending on how old they are, there might be some penalties and things like that. But
Right.
that's something that is something that's, permitted in most plans.
Right.
Yeah. And the challenge is that the penalties can be expensive for distribution too early.
Yep.
But liquidation or redemption, same thing.
Yeah.
The company buying the stock back can be expensive. If the plan owns 90% of the company, and the company is now worth $1 million, then the company has to pay cash of $900,000 to the plan for that stock, to buy back that stock. The cash goes from the company bank account into the plan account of the ROBS founder, the ROBS owner. So that ROBS owner has the money in his or her plan account now, but it's no longer in the company funding what the company uses it for. So what's the company going to do when it liquidates itself to the tune of 90%? Well, usually people actually make that leap of the liquidation by finding new funds, a new shareholder to invest in the company to take the plan's place. That's the option.
And the other thing that they have to keep in mind is the tax consequences. Obviously, if it's a distribution, even if it's in kind, there are going to be income tax consequences. Whereas if they are able to do a buyback, a redemption, then that cash goes into the plan and it can stay tax deferred. So just a couple of things.
Yeah, redemptions are nice if you can afford to do them, because they keep the money in the plan account. It stays tax deferred. If you find a new investor who can, or yourself from after tax dollars, can replace the plan's investment. And you can also redeem in increments. You don't have to redeem all at once. You can redeem have a redemption plan to take 5 years to redeem all of the stock and do 20% per year, for example.
Right.
Something like that.
So I think the Captain Obvious question here, we're hearing all these acronyms, we're hearing all these terms. How does an attorney help with all this as compared to a third-party administrator, Dahl?
Well, the third-party administrators really, they're the basic provider. The attorney comes in as needed. So the third-party administrators in the ROBS industries are called the ROBS promoters, ROBS providers. Those companies, there's several large ones in the country. Those companies that become the third-party administrator as well, but they also go out and sell the concept at franchise fairs and places where new business owners are looking for funding opportunities. So they've got a booth. These promoters will have a booth right next to the SBA, about how to fund your new business. So that's why they're also called promoters as well as TPAs. Then once they get on board a new client, they provide continuing TPA services, the third party administration, to the plan, which is necessary. Of course, you can't live without that. And they carry on. Now, an attorney is necessary if there's, in a couple of factual situations, an attorney can be very helpful. One is determining at the beginning if there's any legal complication for the new ROBS owner, such as existing ownership if they already own a completely different employer. If that entrepreneur has several businesses going, or more than one business going at a time, their ownership of the two businesses may well result in the two businesses having to be treated together for plan purposes as though they were single employer. So that's called being in a controlled group. There's also other kinds of groups that can cause these related employers to have to deal with their employee population as though it were single employee population. And that's, lawyers usually help with those kinds of determinations. And then the other times lawyers can get involved is if there's a question about prohibited transactions, which is really complicated when a ROBS owner or that entrepreneur human being misuses company funds under the rules for ROBS plans. There's a series of transactions that are a series of kinds of transactions that can be prohibited under the Internal Revenue Code that for non-ROBS businesses are no problem at all. So ROBS owners are often unaware of the pitfalls of these prohibited transactions rules. Right. And can stumble into one, and an attorney can help get them out of it, get them, move forward away from that.
Right.
Well, I just wanted to kind of add to this, how an attorney can help. A lot of times when trying to get out of a ROBS plan, the third-party administrator isn't really in a position to advise the client as to what is the best way to exit the ROBS, and right. And what their options are, and helping them set up a plan. So that's also another way that attorneys can help, where a TPA, is not really in that position.
Right. So as we wrap on this episode, Dal and Kathleen, you can chime in as well at the end. What should a business owner consider before deciding whether the ROBS structure is right for their company?
That's a very good question. What they should consider is whether or not they're prepared to remain a C corporation, because taking the S election is fatal financially. So they need to be happy with the C corporation entity. They need to be prepared to meet all of the requirements of the ROBS to begin with. It's not a DIY project. If they think, well, I can just do this myself, there's no way for an owner to do it by themselves. They need that promoter or that third-party administrator, at least. They need somebody to provide them the plan document and help them meet all the regular rules of retirement plans. So they need to be prepared to stay as a C. They need to prepare to comply with retirement plan regulations, right from the beginning, which is a lot to take on. If you're starting a new business, to also be thinking about this other compliance layer might be overwhelming to people, to an entrepreneur. Right. And then they need to be prepared to think about, they need to think in advance how they would like to exit in 5 years, 10 years, 15 years. What's their exit plan for the arrangement?
Okay.
And just a final word, I think it's also important for them to keep in mind that the ROBS plan is a retirement plan. And that means, they need to offer it to their employees. They need to make contributions, and they need to, keep their plan document updated, and all those things that any retirement plan needs. So,
well, ladies, thank you for the time and insights on this topic. I truly appreciate it, as always.
Sure. Thank you, Mike. Thanks for having us.
And thank you to everyone out there for listening to this episode of Employee Benefit Plans and Business Sense. If you're a business owner right now, you're using a ROBS arrangement, or you're trying to understand whether a ROBS plan is right for your company, do me a favor right now. Visit klblawgroup.com to connect with Dal and Kathleen and the team. And don't forget to like, subscribe, leave a review and comment, or share the episode with someone who needs to hear it As always, I'm Mike Leon. See everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.